Aditya Birla Financial Services will be the newest from the table of Aditya Birla Group to get listed in FY18. As we all know, Aditya Birla Group is going through a massive restructuring exercise at the top level. What is going to be the roadmap for Aditya Birla Financial Services? To discuss all that and much more in detail, we have none other than the CEO of Aditya Birla Financial Services, Mr. Ajay Srinivasan. Srinivasan, as always, thanks for spending this time and speaking to ET now. I know it's very difficult to get you for a television interviews, rarely that you appear. Ajay, what is going to be the roadmap? We all know the whole restructuring exercise is at the final lap. So is it the right time, if I could ask you to put a final time frame when we could see perhaps your company started trading in Indian stock exchanges? How it's going to be?
So as you mentioned, I think we are on track, Vijay, and I think there is a number of regulatory approvals that we will have to go through before the demerger of financial services goes through. But I think you're right, it's going to happen in the course of FY18. Our guess is probably in Q1 or Q2 of FY18. So it's not that far from where we are today.
And Ajay, how a different journey it's going to be, because clearly listing also brings with it a lot of set of challenges, so on and so forth. So in that sense, FY18 would be a new journey that the financial arm of Aditya Birla Group would be beginning. So how do you look at it? What are the internal plans that you have? How are you going to chalk out this new roadmap?
So a couple of things, Vijay. I mean, firstly, we've been a part of a listed entity. Aditya Birla Nuvo has been listed, and in that sense, we've been a large part of Aditya Birla Nuvo. So to some extent, we've been a part of a listed entity. However, I do think it's going to be very different. Listing by ourselves and being exposed to a stock market price, analysts, media, all of that is going to be a very different world for us. But my sense is ultimately, if you run your core business well and you do that job well, then hopefully the other things become much easier to deal with. So we just have to continue to focus on our business and continue to add value, and we're hoping the rest of it will kind of follow from there.
Ajay, if my numbers are right, there are 13 businesses in the financial services group. Going forward, which is going to be your focus area? And also I'm asking you at a point of time when we all know insurance sector also a lot of buzz is taking place, listings have started happening, IRDA is coming out with its own set of rules. So which is going to be the vertical where you see the primary growth coming in for the group?
So let me answer that question in two parts. I think firstly, let me explain to you what Aditya Birla Financial Services has and why I think it's a slightly different proposition to what's there in the market. Today we think we are probably the most diversified financial services business in the market, the non-banking financial services. We really have, as you say, 12, 13 lines of business that cover pretty much any need of a customer from the time they're born to the time they die. And the ability to be able to meet the needs of somebody across that spectrum really gives us an ability to build really long-term relationships with the customers that we choose. So that I think in a sense is slightly different from other propositions in the market. Within that spectrum, I would say there are 3-4 large opportunities that we're currently present in. We see opportunity in every segment. I must say, every one of our segments we see large headroom to grow. But obviously there are some that are going to be larger than the others. So let's take life insurance. You talked about life insurance. The life insurance industry has grown pretty rapidly. If you take the results this year till February, the industry has grown about 20% year on year. We've grown about 36% year on year. So I think we're doing better than the industry, and we hope we can continue to maintain that. I think life insurance is going to be a large segment going forward. Asset management is another segment that I think has done very well, especially post demonetization. That if I look at the March quarter to December quarter, industry has grown about 25%. Average assets under management grown 25%. These are significant numbers when you think about the base we're talking on. And we've grown faster than that. We've grown about 32%. Our NBFC is now a large NBFC. We manage somewhere like about 35,000 crores of assets in our NBFC. That again has grown faster than the market. My sense is if you look forward, protection, health insurance, life insurance will be one piece that I think will continue to be large. Asset management, wealth management will be another piece that will continue to be large. And the lending piece, whether it's our NBFC or our housing finance piece, I think put together, I think these are going to be, in absolute terms, I think these are going to be large segments of our business going forward.
Ajay, if I could ask you in that sense, as you're rightly saying, NBFC, mutual funds, insurance, so on and so forth. FY17, we all know, had its own set of challenges. The demonetization happened in the third quarter. We will discuss that in detail going forward. How do you intend to close FY17? Perhaps just a week left. last quarter.
Yeah.
From the group perspective, how do you see in terms of growth and in terms of numbers, where do you see FY17 getting close for you?
So I can't obviously tell you about our current quarter, but if you look at our December numbers, you'll see that we've had very good traction both in top line and in bottom line. And we measure, a few other things that we look at. We look at our lending book growth. That's been very strong as of December. Our assets under management growth, that's been very strong. And as I've just given you, we are growing faster than the industry, in all our large businesses. So that should ultimately result in decent numbers.
And going forward, the double-digit growth story continues. Looking at the macro picture, how do you see it?
Yeah, like I've always said, I think India is one of those markets where I think we are structurally built for many years of good growth in financial services. We have an economy that's growing fast. We have therefore per capita incomes that are growing, and most financial services products penetration levels are still very low, Vijay. Whether you take mutual funds or you take life insurance or you take health insurance or you take lending, in any parameter you take, Indian penetration levels are still low compared to almost any other economy in the world. When you get that combination coming together, then I think you're ready for a number of years of growth. Now that growth may not come to everybody in the industry. You obviously have to, it's not your birthright, you have to work hard to be able to get it. But the basic structural story is such that there is growth available for people, who are able to get the right combination together.
Ajay, one more important aspect, and this is one thing which the markets are also keeping a close watch on how you will do it. We all know that IRD has already come out with a discussion paper when it comes to making it mandatory or not mandatory, the listing of life insurance companies. You are at a stage when we all know the restructuring is in the final lap, as you're rightly mentioning. So would you continue to keep insurance as a part of the group, or there are options which you'd look at to continue or carve out insurance as a different vertical and not be part of the group? What is the line of thinking?
No, I think insurance is very much a part of the group. There's no question of insurance not being a part of the group. But if your question is whether we will list the insurance business separately at some future stage, I mean, we really haven't thought about that. As of now, the plan is to list the holding company. The holding company has a number of financial services underlying that, and that's the plan we intend to go forward with.
And Ajay, we all know that of course when it comes to listing, it would be a different ball game with bankers doing the number crunching. But at this point of time, how do you see the financial arm of Aditya Birla Group in terms of the value or in terms of how the total size of the group at this point of time?
It's difficult for us to forecast a number, Vijay. I mean, like I say, our job as managers is to make sure we do a good job, we build a good business, we build a good, good platform to be able to grow. Valuation is something that the market will decide what the valuation is for a business like ours.
As always, you're not ready to put any numbers, Ajay.
Yeah.
But if I could ask you, in terms of growth, say NBFC and mutual funds, would that continue to remain, say, the biggest vertical in your balance sheet even going forward, the way you have built it in the last, say, a decade or so?
So I think the different parts of our businesses contribute differently. If you look at revenue, for instance, our life insurance business is a large contributor to revenue. Profitability, the NBFC is the largest contributor to profitability. If you look at just return on equity, our mutual fund business would be a significant contributor to our aggregate return on equity. So I think each business plays a role in terms of how it contributes to the overall. And like I've said, these three are really three large pillars of our business, and will continue to remain so going forward.
Ajay, we all know recently you entered the health business with a new South African partner.
Yeah.
Also, would this be a model that you would prefer when you enter newer verticals going forward? And do we also see perhaps some divestment or getting in some new partner happening before the whole listing happens at the group level?
So our approach for new businesses is where we find that there is some value that we can get from a partner which we don't have ourselves. And the health insurance example is a good example. I think our partner has such strong IP in the whole area of health and wellness, working in South Africa or all of Africa, but clearly some of that is translatable into an Indian context. Then we see that there's clearly value that we can get from getting a partnership. A partnership must make sense to both partners, and the partners must bring some different skills to be able to create an entity of value. And that's the basis on which we figure out whether we do something ourselves or we find a value in bringing in a new partner. So when you're coming out with a proposition that is different, and you feel that there's somebody who has the ability to strengthen that proposition and deliver that proposition, then we think that a joint venture is a good way to be able to deal with that.
And Ajay, looking at the growth prospects, the way macro indicators are panning out, what is going to be your philosophy? Would it be purely organic growth, or you're open to inorganic growth? What is going to be the line of thinking going forward?
So, we've been of the view that consolidation is something that's going to come in the financial sector across the businesses which we operate. Life insurance, we feel that there are many players, and therefore some of the players would look to exit, and therefore there will be consolidation opportunities. Same in mutual funds, same in NBFCs. But at least so far, even though we are constantly on the lookout, we haven't really found something that has made both a strategic and a financial fit. And therefore, while we continue to look, we haven't found anything that makes sense for us to do. But I think we will continue to look at that, because we do believe that consolidation is the way forward. And look at the mutual fund industry. If you take the top 10 funds, they account for probably 90-95% or even 100% of the profitability of the sector. The same is true in life insurance. The same is true in NBFC. Whenever you see that kind of a configuration, you can be reasonably sure that consolidation will happen at some stage in a sector.
Moving on to some other aspects. Finally, if I could quickly ask you, in terms of the overall pie, in terms of market share or in terms of revenue, however we look at it, how do you see the pie panning out for you in the next 3 years with the kind of areas and verticals that you're operating?
So our measure of success in many cases is really driving, increasing our market share, because we can't predict whether a life insurance business or a mutual fund business will grow at 15% or 20% or 25%. Last year has been a very good year for both these sectors. Therefore, our effort is really to try and grow faster than the market. So I would say across the platform, you should see us being really looking to see how we drive growth in market share, across the board. And it comes from two ways. One is we can drive increased market share in the current pie that we have. But the second is to start looking to see how we expand the market. Because like I say, when you have unpenetrated segments like the ones we are operating in, part of our agenda is really to expand the market. How do you bring people new into the segment? Because as you bring them in, the market share also grows, but your market share increases if you're able to get a larger share of people like that.
And the other area everyone is looking at is the payments bank. How close are you, and what is going to be your model? Because we see other players also rolling out. And how close are we seeing the launch of payment bank from your table?
So we are in the regulatory process at this point, Vijay. So we really don't know when approvals will come through for the payment bank. But we look at the payment bank as an opportunity to really access a very large base of consumers. And I've said this before, saying if you look at the telecom consumer base, it is a really large base compared to normal financial services players like us have access to. So we can marry the two, leverage the reach and infrastructure of a telecom network, and are able to sell financial services products through that. That could be a very transformative experience.
Ajay, coming back to the customer-centric business that you are in, I believe we met somewhere in the month of November when the demonetization was just announced. Now, we all know things have settled down, how things have moved in. How do you see the whole process? And clearly from the businesses that you are, do you see the markets or the corporates as a whole have completely recovered from the hurdles of demonetization?
Yeah, I think demonetization was a temporary adjustment in many ways, and I think it's clearly adjusted. So you take home finance. We saw in the housing finance mortgages business, we saw a big slowdown in November because of demonetization and what people were thinking about. December was a reasonably strong month, and January was an even stronger month. So I think in many places we've seen the momentum come back in a very strong way, and I think the market is adjusted. But I think in a big way, if you look at some of the underlying changes, I think you're seeing a greater formalization of the economy as a result of demonetization. Much more money is coming to the formal system. And also if you look at the winners and losers, I think the unorganized sector clearly continued to have some issues through demonetization and post it, whereas the formal sector has gained. And I think those are trends that are likely to be more longer term.
The other important aspect is, Ajay, for a big group like you with such huge customer-centric businesses, digital, which is the buzzword now, how a different journey has been it for players like you, say, between November after the demonetization was announced and now? What all retuning you had to do, and clearly how has it changed your business models?
So digitization to us is a multi-year theme. I think demonetization gave a bit of a fillip to some businesses as a result of that. But I think digitization is really a multi-year theme, and I think we see it as a big opportunity really in many ways. It gives us an opportunity to reach many more customers, and therefore you will see digital assets in all our businesses that allow us to reach a wider base of customers and acquire customers. It gives us the ability to enable our sales force in a way to make them more productive. So you will see digital assets being deployed by us across the board to enable greater sales productivity. You will see us being able to leverage digitization to reduce costs in many places, because we have the ability to use digitization to reduce costs from traditional processes. So I think digitization really is going to change a number of parameters, and we've embraced it completely at Aditya Birla Financial Services. It's a very key part of the way of our thinking about the future of financial services.
I am asking you this particularly because do we also see big corporates like you in that sense? The overall investment that happens through a CapEx cycle every year, perhaps the investments happening in digital cycle would be the maximum going forward, the way things are panned out clearly, as you are mentioning, the whole ecosystem getting changed?
Yeah, I mean, from a financial services perspective, I can definitely tell you a lot more of our investments are going into digital assets, because that's where we really need to build capability, build the organizational skills, and all of those things. So from a financial services perspective, definitely I would say a larger part of our investments would go into digital assets.
Ajay, looking at the macro picture, how do you see things panning out? FY17, although because of the demonetization, the numbers are already out, it's open for a debate. How do you see FY17 panning out? And clearly with this base, how do you see we entering FY18, and where do you see the growth going forward?
So I think, like you say, the forecast for FY17 have already been brought down a bit. So we're talking about GDP estimates between 6.7% versus 7.8% last year. So we are expecting a slowdown this year compared to the previous year. And when we look at some of the high frequency indicators that we follow, we are seeing a general sense of this playing out. So when you look at core IIP, or you look at number of other indicators, you are seeing that that this is likely to result in a slightly slowdown compared to the previous year. But I think what has changed, at least post the elections, is a real change in sentiment. And I think that change in sentiment will ultimately lead to change in activity on the ground in terms of investments, in terms of people's willingness to take investment calls and build capital and invest capital. And I think therefore you should look at FY18 slightly more positively. So while a lot of the indicators on the ground today don't look like they've changed, my sense is you'll start seeing that change as you go through FY18. So we are much more bullish about FY18. We think inflation will be under control. We don't see interest rates really moving very much from here, and therefore that should hopefully signal the resumption of capital investment.
Would GST now, July 1st, the date being talked about for rollout, be the key game changer in that sense for our economy?
So I think from an economic perspective, I think GST is a really big reform. I think it's going to take some time for it to play out in the economy, for all the value to get generated, but it'll be wonderful if it happens in July 1 and we can move into a GST era. I think we'll start seeing the benefits of that over the next 12 to 18 months after that.
Ajay, although your balance sheet and the quality of assets would be different, but in general, we all know the debate on NPAs and how it's panned out, and a lot of measures from the government side or the individual bank side has been taken, but clearly things are not changing at the ground level. You also are in certain consumer-centric business like your NBFCs and housing finance. Where do you see the actual problem lies, and how do you see this NPAs mess turning out? Particularly, would it be the biggest drag or the biggest challenge as far as the economy goes on the credit side?
So I mean, I wouldn't be saying anything revolutionary if I say that NPAs have held back the banking system from expanding. It hasn't been a problem so far because credit demand per se has been slow. But if credit demand does pick up, then obviously the NPAs is going to be a drag on the banking system to be able to grow credit in line with the credit demand that's going to come. So I think we have to get prepared to be able to solve that problem, so that when credit demand actually picks up, that our banks are able to grow and are able to lend to the sectors that require credit. But you're right, I think there is a big difference in credit quality across different parts of the system. If you look at the overall NBFC NPAs, it is lower than banking NPAs. If you look at the NBFC sector NPAs and our NPAs, it's completely different. So the average NPA in the NBFC sector is like 4.5% or so, gross NPA. Our NPA, gross NPAs will be 0.7%. So I think there are different cuts right across depending on which segments you operate in, what kind of processes you run, what kind of credit risks you're willing to take.
NBFCs particularly I'm touching upon, Ajay, because clearly that would be the key when it comes to the growth, particularly at the tier 3 or the rural areas. Do you think this is a sector where we see consolidation eventually will happen and you need big players in terms of having big wallets to ensure that the growth happens or the credit flow continues?
So I think I think you will get larger NBFCs over a period of time. I think you can still have NBFCs that work in niches provided their costs are managed in a way that allows them to run the economics. But by and large, I think you're going to end up with a few larger NBFCs that are going to continue to grow. And you're right, I think they have the ability to grow geographically. They have the ability to reach customer segments that I think are underserved or not served at all today by the traditional banking system, and I think create disruption to many of the traditional modes of financing that exist today. I think all of that is possible with the NBFCs we have today.
Ajay, when you speak to your fund managers, mutual funds as a sector has been on a roll for the last 2 years, particularly this financial year. On an average, close to 4,000 crore plus is the amount that is coming into via SIP into the industry.
Yeah.
How do you think this momentum continuing going forward, and do you think perhaps mutual fund sector as a whole has done a lot of right things which perhaps was not the case couple of years back, and this momentum could continue with the kind of inflows and growth that we are seeing?
So I think the two big changes in the mutual fund sector, which I think will play to longer term growth. One is the move to SIPs, as you said. Last month, the industry got 4,000 crores of new SIPs. That's a big change because that means every month you're ready to get 4,000 crores of new retail money coming in. The more retail investors access the market through SIPs, the more likely they're able to deal with the volatility of the markets, and we should be ready if that markets will be volatile. And I think as a result of that, what you've seen is that when markets correct, you don't see an outflow in mutual funds, what we used to see earlier. I've been in this industry for very long. I've seen how this industry has evolved. I think SIP is one big change in the industry that's driving a lot. I think the second big thing that I think has changed this industry is investor education. I think the move by SEBI to make sure that every mutual fund invests in investor education, and AMFI is also spending on investor education, I think has clearly changed the understanding of the common investor about mutual funds. And I think that has clearly made a big difference in terms of understanding of what the sector can do for you. So I think this combination of SIP and investor education has led to much more stable flows. And I therefore am much more bullish about this industry. I think this industry will continue to grow in the future.
Ajay, before I could wrap up, just touch upon fourth quarter and the new calendar year. The first 3 months has been a roll when it comes to the equity markets. The bull run, many would say, is just at the beginning. How do you see this? Is this a bull run which can be sustained looking at the macro picture, looking at the current environment? You meet people globally, you interact with people. Do you think this inflows continuing, and particularly also the domestic mutual funds able to sustain this? This bull run is here to stay?
So I would say the first quarter, at least if you talk about the market, I think it's been a function of a couple of things. I think domestic liquidity has been fairly ample, and then we've had the Trump rally as well. So I think it's been a mix of two things. My sense is that liquidity has driven the markets and probably a little bit more than we would have otherwise thought. But the longer term trend, again, Vijay, if you look at it, is real rates in India have been positive. That's always good for financial assets. And if you look at where people traditionally used to invest, they used to invest in property. Property has been flat over the last 3 to 4 years. They used to invest in gold. The stock markets have beaten returns on gold, whether you take 1 year, 2 year, 3 year, returns into account. So therefore, people are getting more confident that financial assets are a place where they will get decent returns, and that has led to therefore greater inflows into the stock market. General ownership of stock markets is still low, but I think we are in for a good run in terms of stock markets just from a liquidity perspective. Earnings will be a key challenge. I think earnings have to catch up with where the markets are currently, but my sense is over a period of time you will see that happening as well.
Finally, would FY18 be the turning point for the Indian economy that we have been struggling or looking at in the last 3 years? Importantly, you saying earnings, there are indications that it would pick up?
Yes, I think there are a number of other things that have worked. If you look at the Indian economy, I think I talked about inflation. Inflation has really come under control, and we see that continuing to be the case going forward. That's one big piece that I think has been addressed by the government. If you look at our external sector, I think although the CAD is increasing slightly today, the wonderful thing that's happened is FDI now is almost funding our entire CAD. So our entire current account deficit is funded by FDI. That's a wonderful place for us to be from an economic point of view. So what is left to be done really is for us to see a resumption of investment demand. I think that's the one thing that I would personally like to see happening in FY18. As I said, if you see sentiment has already changed, and if that sentiment continues to be the way it is currently, I'm sure you will start seeing capital investment coming back. And then we're in for a really good period of growth in the Indian economy.
Ajay, once again, thanks a lot for spending this time. Pleasure talking to you, and hope to see you soon and speaking to a CEO of a listed company.
Sure.
Thanks, Ajay.
Thank you, Vijay.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.